Hey everybody, my name is Kevin Acevedo. I am one of the managers for the company Feet R Us for the business simulation game. I will be covering a couple of slides talking about the background of Feet R Us, our vision statement, mission statement, code of ethics, and a couple more slides after that. So here we go. Talking a little bit about just kind of how Feet R Us started. As far as the name goes, we noticed that, our team name, we were assigned the letter F, and so we were kind of throwing around a lot of different examples of, names of companies that have, the letter F, like Foot Locker and like stuff like that. Obviously, we weren't going to pick something like a Foot Locker, but we were just throwing around all these names, and honestly enough, I saw a commercial, a Toys R Us commercial, and then I started thinking about, wow, I haven't been to Toys R Us in the longest time. And because we were a shoe company, I just said, hey guys, why don't we just name it Feet R Us? And then Justin and Matt both started laughing and thought it was kind of ridiculous, but you know what, the name stuck. So we decided to go with Feet R Us. The logo, as you can see off to the right over there, it is a F standing for Feet R Us, and it's got kind of like a wing design, a little bit of feathers up on the back of that, and I don't know if you can see it or not without making the logo very large, but in the previous slide, on the title slide, you can see on the inside of the F, there's a little bit of texturing in there. It's supposed to, I think it's a microscopic view of a butterfly's wing, so you can kind of see like the texture of like the feathers and the wings and all that kind of stuff. Our company slogan is "You would walk a mile in our shoes," basically paying an homage to the popular saying like you wouldn't want to walk a mile in their shoes, but in reality, because our shoes are so popular and they're comfortable, it's a no-brainer as to why somebody would not want to walk in a mile in our shoes. Our vision statement was pretty simple. Our goal was to continue to expand our global reach while creating shoes at affordable prices. The plan was to expand our operations into the private label sector by leveraging the healthy market share that we own. We want to continue to grow earnings and return our values to our shareholders. Our mission statement is simple: give people shoes. We aim to provide an affordable shoe with multiple options so that people can have the ability of purchasing a shoe. We will do whatever it takes to make sure that this happens.
Feet R Us goes by a strict code of ethics. We want to treat all customers and team members fair and with respect. We want to conduct all business transactions ethically and fairly for all. We want to build trust and credibility with our stake and shareholders. We want to maintain a healthy and safe working environment for all. We want to conduct all business decisions with shareholders in mind. And then we want to create a quality and reliable product for all. Some of you might be wondering, what will we do differently in the future? Well, one thing we would do right off the bat, if this continued a couple more years, is we would want to build more capacity sooner. And one of the reasons we'd want to do that is because we don't want to just be a market leader in the basic market share, but we also want to take over the private sector. We would want to be number one and take over majority of the private sector. Also, what we would do in the future is we would issue more debt instead of stock. This would help decrease the shares of stock and would raise EPS and ROE for our shareholders. Along those lines, we would also continue to issue more debt in order to repurchase stock back, which would also increase EPS and ROE. We would do that because we feel like the longer we wait, the higher the stock price will go, and it's pretty cheap for us right now. Another thing we'll want to do is we'd want to offer a dividend. This right here should help shoot the stock price up throughout the next year, which will be good for our shareholders. We have been quite successful in the private label. One of the ways we've done that is we have never actually sold unused capacity. All the extra capacity we've had, we've put into the private label market. So is what we've done since week 11 is we have increased our price, and then the trend has caught on with our competitors. In the beginning, private labels were in the 20s for the price to sell the shoe. Towards the ends, they're in the 30s. So we currently, is what we started doing at the end, is we started selling the shoes at a higher price in all the different markets. So if we lost one market, it wouldn't completely devastate the company's earnings. So in the future, is what we'd like to do, is we would like to build more capacity. And the goal of this is to be and have 90% of the total private label market. By doing this, this would actually cause us to have to decrease our price in the future to ensure that we could keep all the market share.
Looking through some of our strengths, one of the things that we want to note is we had really good price. We consistently offered lower prices across the board. We invested a lot in facilities in order to gain a competitive advantage. So I would say having a high capacity was a pretty big strength of ours. And also just we had a lot of high celebrity appeal. One of our uh, pieces of our strategy is to invest a lot in celebrities to help expand the market share that we would have. Because I think that we knew that we weren't going to be able to produce a high quality of shoe, which leads me um, to the next thing about our weaknesses. We laid off a lot on improving the quality of our shoes. We focused more as trying to create a mid-range shoe that way to help justify the kind of price that we were pushing out. And so we were trying to use our high celebrity appeal to offset that. Another weakness that I would say that we had is just we took on a lot of debt. A lot of that debt was used to expand so that way we could produce as much as we were able to do. But I think in the end, it hurt us a little bit. And you can see that in our credit rating towards the end. We were consistently having A plus credit ratings until the latter years where it dipped down to just an A rating. I think there were a lot of opportunities that we could have taken advantage of if I had to do this game again. I think looking at the private label, um, there was a lot of demand increase each year that went unsupplied. And honestly, with the amount of capacity that we have, we could have adjusted things in the retail side so that way we would have saved some more space to sell in the private sector to be able to meet that demand. With that unsupplied demand, we would have had that ability to charge a higher price, which would have greatly increased our margins. That way, we could have earned more money that way. One of the threats that we found was just the reduction of market share due to other companies offering a higher quality shoe for similar prices. That's one of the things that we struggled with is just trying to find that balance. Um, but credit to the other companies for being able to find that and be able to compete effectively against us on that level.
The next section we're going to dig into is the financials for Feed R Us. From the chart, you can see that our EPS rose from year 11 through 12, decreased in 13, and increased every year since then. Year 18, we ended at $5.94 a share, which was our highest EPS yet, and we continue to see that growth in the near future. Here's what our ROE looked like from years 11 to year 18. It increased from year 11 to 12, took a big hit in year 13 when it was a tough market for us and all of our competitors. In year 14, 15, and 16, our ROE again rose and took the biggest jumps from year 13 to 14 in years 14 from 15. We took a slight dip in year 17 before reaching our highest levels by year 18. Here's a graph that shows how our image rating trended from years 11 through year 18. The next thing I'm going to talk about is our credit rating. This credit rating helped us and gave us an advantage in a couple of years that our competitors did not have. As you can see from the graph, the investor expectation was for us to have a B plus through all the years. We exceeded expectations in every year except for year 11, where we just met our investors' expectations. We put a high emphasis on the credit rating and was very happy in week 14 when we were able to get an A plus credit rating. This was important to us due to the fact the better credit rating you had, the less interest you had to pay. As you can see from the table, our credit rating compared to our competitors played in our favor week 11 through week 15. In those weeks, we had a higher credit rating or the same credit rating as our two main competitors, Caliber and the Decepticons. In years 16 and 18 is what we did is we issued more debt and we bought back stock. We did this because we thought our company was undervalued and that the stock price should be higher. Since we took out more loans, this actually decreased our credit rating slightly to an A instead of a perfect A plus like our competitors have. We feel like this actually gave our competitors a slight advantage over us at the end of the game.
Here we see the graph that shows our stock price compared to two of our competitors. Throughout the duration of the game, we see an increase of stock price from below expectations of the investors to well above the expectation of the investors. The reason for the dip in the very beginning in the first half of the game was we issued stock to generate capacity for our markets. And after we were well underway and going strong in all of our markets, we shifted the focus to a stock buyback program that enabled our stock price and EPS and other ratios to show a positive increase. And the design or the path of our stock price was by design from the very beginning, and we knew that a short-term decrease in the stock price was that only that it was short-term. That overall, that the strategy that we entered into the game with, and then we went down for our stock price. We knew that with the way that we were conducting our business through the game, that the stock price in itself would eventually come above the expectations, and that it did. And we see from year 14 a nice increase overall in the stock price compared to our competitors. We see that we were up aligned with Caliber and over and above Decepticons. One of the best ways for a company to compare themselves with their peers in a given industry or a given market is looking at their overall global market share within that industry. Here we see the Feet for Us market share going from year 10 to all the way to year 18 when we ended, and we see throughout the very life of the game and through the course of business and the years, we see a steady increase in market share from year 11 all the way till the end of the game of year 18. As we ended the game, we see a market share globally for our company at about 25%, and with 5 companies, that is an area that we are very proud of. That to say that we had a 25% market share in the footwear industry. One of the areas of the income statement that we focused on at Feet of Us was the net profit. That was a line item that we looked at each and every year, and one that we did focus on. Here we see how Feet of Us compared to our other competitors, Caliber and Decepticons, and we see that we as a company was consistently over and above our competitors, except for year year 13 was the only year that we dipped, but I think even Nike dipped on year 13. So we wasn't too concerned about that, looking at us compared to everybody else. But as we came out of year 13, we see an increase of net profit and a steady increase, and continue our trend line from year 13 was a trend line in a positive direction that we felt was a clear indicator of how we were operating, and the decisions that we were making were paying off at the bottom line. Here we see the current ratio for our company, Feed R Us, along with two of our competitors, Caliber and Decepticons. As we know, current ratio is being the company's current assets divided by the current liabilities. We see in this instance, at least for our company, Feed R Us, that our current ratio was actually below our competitors. The reason for that, the driving force behind a lower current ratio for our company, stems from the aggressive stance that we took from the very beginning on building capacity in all of the markets. By being able to build capacity in the markets, we assumed and took on a little bit more debt than some of the other companies did to be able to do that. So where we feel that the building of the capacity by the utilization of debt to do that might have decreased our current ratio and some of our ratios like that at the beginning, we do feel that in the long run, if we would have continued on this path and continued on years down the road, that the aggressiveness in the beginning would have paid off, and we'd see this ratio at years to come being right up there with our competitors. Debt to equity. We see our debt to equity for our company versus the Caliber team and the Decepticons team. And we see at the very beginning that the three of us was separated, especially in year 12. But we see as the years progressed, one of our strategies, as you'll hear in the near future, was the consistency of our company, and we see a pretty consistent debt to equity ratio for us from year 11 all the way to year 18, and we see that the three of us at the very end of year 18 was pretty similar debt to equity ratio. So here's another ratio that shows the consistency of our company throughout the course of the game.
The next thing I'm going to talk about is cost per pair. In week 11, our cost per pair sold was $21.16. This was led by three main costs. The first cost was material cost standard, material cost superior, and labor cost for regular pay. Labor cost was always a big cost for us just due to the fact that we always maximize labor. Material superior cost was higher because we didn't have a chance to do our plant upgrades yet. That would enable us to use less superior material and at the same time have the same quality shoe. Year 14 cost per pair sold is similar to the cost per pair sold in week 13. Overall, the cost actually increased to $22.81 a pair. Once again, the standard materials and superior materials were the highest cost that we had. This is due to us producing more shoes and the cost per materials increasing. One of the things that did decrease was the labor cost, and this is due to the fact that more pairs we have, the less labor costs we're going to need to produce the shoes. In week 18, our cost per pair sold actually decreased to $21.52. This was for a couple of reasons. The main reason was the labor costs, once again, slightly ticked down. The superior material cost also decreased. But this wasn't our lowest year for cost per pair due to the fact that the material cost for standard materials actually jumped almost $1 per pair sold. This actually hurt costs a little bit, but we're still fortunate to lower the cost per pair sold to $21.52 by year 18. This is still higher than the cost per pair sold in week 11, that was $21.16, but a lot better than the cost per pair sold from year 14 at $20.81.
Now we're on the value chain analysis portion of our presentation. Just looking through our primary activities, these are some of the things that we decided that was important and what we were focusing on. So we wanted to diversify our manufacturing locations by building capacity in each market. We focus advertising and marketing strategies along with having a cognizant effort to bring on board an increased number of celebrities each year. We decided to try to generate a high amount of retail outlets. During the past 8 years, we were able to decrease delivery time by 1 week to 2 weeks. Maintaining a consistent product quality is very important to us, and we were able to do that by using a consistent amount of superior versus standard materials. Some of our secondary activities that we did is being able to offer the TQM and Six Sigma quality programs and best practices training offered for employees in all 4 of our markets. We were able to offer competitive wages for workers along with overtime pay, along with employing about 3,793 people by year 18. And we were able to upgrade our facilities throughout the past 8 years. Looking at our core competencies, this is what we wanted to basically dictate our business around. While some of the companies decided to shift from low cost, low price or high quality to high price, we decided to focus on creating a product that was the best balance between the two. Our goal was to differentiate Feet R Us by creating a mid-range shoe for both quality and price. This was aided by our aggressiveness in building capacity in all markets, which allowed us to keep overall cost per shoe lower.
In looking at our business strategy, one word that can encompass our strategy from the beginning to the end, from the quality and the price of our shoes to our financials, is the word consistency. We decided and felt from the very beginning our best business strategy would be a consistent company. And what that meant for us was we wanted to offer a quality shoe at a quality price and stay within that mid-range part of the market. We felt that there would be companies that would go for the low quality, low price end customers, and there would be some companies that would go for the high quality, high end, high price customers. We felt that the best business strategy for us was to stay within that mid-range. Not only that, but another part of our business strategy was to maximize capacity by building capacity in not just 1 or 2 markets, but in all markets. We felt that by doing that, the diversification of building in each market would be a business strategy and it'd be a benefit for us in future years, not only in thinking about this game as to year 18, but also down the road. Also, we wanted to maximize the sales revenue and the net profits, and by maximizing capacity, we were able to increase our sales revenue, and with a strategy of being in all 4 markets and keeping our costs and keeping our expenses at a reasonable rate, we were able to maximize our net profits. By doing both of those, we saw the ability to capture and maximize a good part of the market share overall. We also looked at the private label, and we felt that as a business strategy was a good area to enter into and a good area for us for additional sales and profits. Not only all of that, but we also had in the forefront of our minds and was constantly looking at the investors' expectations. With being a public company, we knew that the stockholders was a big part of who we were working for, and we knew that we looked at our stock price, we looked at the ratios that the investors were looking at, and we strive to exceed their expectations each and every year. Throughout the whole course of the game, we looking at our trend lines, we see that our trend lines consistently increased in a direction that was positive, a direction that would allow us to, for years down the road, be able to be a competitive company and offer a quality product at a quality price. And by doing We feel with what we did through these 8 years that we ran the company, it set it up for many years down the road. So that was our business strategy from the beginning. And next we're going to talk about the evolution of the strategy. As we look at the evolution of our strategy, as we learned from the previous slide, was our business strategy was to be a consistent company. From year 11, from the very beginning, we strive to be that consistent company in the first few years. And after those first few years, we soon realized that that consistent approach that we implemented and initiated back in year 11 enabled and allowed us to see a gradual increase in almost all categories. By remaining in that mid-range part of the market, we did not try to separate ourselves by altering the quality or the price to have a knee-jerk reaction or react suddenly to something that the market was doing or that another company was doing. We chose to remain consistent throughout those first few years and then realized real quick that that was the best strategy for us and the strategy that was working. And as we progressed and even as we entered into the final few years, we saw that consistent strategy to come to fruition and to become beneficial. And it was a strategy that we feel was the best for our company from not only the very beginning of year 11, but all the way through the final year 18.
So, what have we learned? One of the biggest things that I took away from this, and I think Matt and Justin would also agree with me, is that you just have to play the rules of the game. You have to play by the rules of the game. And what I mean by that is there are a lot of times in our discussions where we would talk about things and say, like, well, logically, I think we should do X. And then we would start putting it together in our in the game. And then when we looked at the projections, we saw that things just weren't lining up the way that we thought it would do. And so that kind of dictated our strategy a little bit. We just had to adjust and kind of see what is it that would work the best, not only for the company, but also just for the sake of the simulation. Um, we just kind of had to play with the hand that was given to us. Learning to play with a hand that we've been dealt is very important because it's also just like a general life principle. Sometimes with external circumstances, if things fall a certain way and it's out of your control, you have to learn how to adjust and come back from it. So for us, whenever we would lay down these projections and we would put in like the final numbers, and then the following week, once we would get our results, sometimes things didn't turn out the way that we wanted it to, or if a competing company decided to mimic a similar strategy, but they got those, either whether they stole market share or they were able to sell a little bit more than us, we just kind of had to adjust given our circumstances and what the results were falling out. And one of the final things that I learned is honestly take advantage of the small windows of opportunities. So one of the biggest things that stands out to me was that time when Professor Haggard, she had sent out that email talking about how everybody was killing each other in the private label sector. And immediately after that email, we were looking through the data. We just noticed that a lot of people, if not all, we all just backed away from the private label sector, and we tried to figure out what are other avenues that we can do to help make our company successful. Towards the end, we decided to go back to the private level sector and make that a part of our core strategy and use that to help sell a lot of our shoes just because we had the capacity to do so. So that was one of the opportunities that we took advantage of and helped benefit our company.